Good afternoon, ladies and gentlemen. Welcome to PELATRO PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Sebastian Menon, CEO, and Nick Hellier, Finance Director of PELATRO PLC. Good afternoon.
Thank you, Paul. Thank you very much, and thanks everybody for joining this live results presentation. I'll introduce myself shortly, but before that, let me tell you that we'll be taking you through a presentation for about 30 minutes or so, 25 to 30 minutes, and post that we will throw the floor open for questions. We'll also be answering some pre-sent questions. So with that, let me just start. Let me just get going with the presentation itself. So that's me. I'm the Managing Director and CEO. I come with almost 25 years of experience in the telco space, having built another company called Subex initially and sold the business in 2012. That was called Subex. And then I moved to PELATRO, having co-founded that in 2013. So that's my background, graduate engineer with significant experience in software industry. Nick?
Thanks, Sebastian. My background is mainly in investment banking. I qualified as an accountant with KPMG many years ago, then went straight into banking, where I spent the next 20 plus years. I was variously with UBS and HSBC. I joined PELATRO halfway through 2017, ahead of the float. For those of you who've been following us, we floated in December 2017, and I've been with the company ever since then.
Thank you. We will touch briefly upon the results that we have at this point in time for the financial year. As you know, our revenue did decrease this year, and so did the profit. I mean, we went into a loss situation, and this happened solely because the company over the past 2 years, 2019 and 20, have been focusing on moving from a license fee driven model to a recurring fee driven model. So that naturally means that we don't have the chunky revenues that come with a license contract. And but in the long term, the recurring revenue contracts are much better because we are constantly setting up a foundation to move forward. So we keep building on the foundation. So when that change happens, naturally the revenues drop quickly. In the year where the impact is the most, the revenues drop dramatically, and then they will come back up when the recurring contracts start yielding revenues. So that is the sole reason. So had we not changed the model in 2020, our revenue would not have fallen, rather it would have grown. But only because we changed, it's happened. But the change is for the better, for the long term. This is a much, much better model that we have. So in 2021, you will see that come back again. As you all must be aware, the guidance at this point in time from Cencos is $7.2 million of revenue in 2021. And there you are actually seeing the result of the recurring revenue helping us quite significantly. Moving down further, last year we did have an equity placing of about $2.6 million, and as I told you, our focus currently is on recurring revenue, which has actually moved from $4 million at the end of 2019 to $5.4 million at the end of 2020. So that's a 35% increase. Now, what exactly is this recurring revenue? So here, basically, what's happening is we have very long-term contracts of 3 years and 5 years. And there are monthly fixed revenues, fixed fees in those contracts, and we keep getting that every month. So it's exactly like a SaaS contract, a software as a service contract, where we are paid a fixed fee every month. Annual recurring revenue means the run rate at any point in time. So if we go and sign up another contract, say in the next 1 month, where it is $500,000 of recurring revenue a year, that annual recurring run rate revenue will move from 5.4 to 5.9, and then so on like that. So at any point in time when we declare the annual recurring revenue, that is a run rate that's there at that point in time. We will also share with you the actual recurring revenue in a year, depending upon when the revenues start kicking in, because in a contract of that nature, once we sign the contract, there'll be at least 4 or 5 months during which we implement the product before we can actually start getting revenue. The gross cash at the end of the year was $1.81 million. Nick will tell you more about that later, about the trade receivables as well. But the interesting thing is that of the entire trade receivables we had at the end of the year, half has already been collected this year, so our collections are improving quite nicely. A very, very important thing for you to know from a scalability of the product, we now have a customer and they have about 400 million subscribers in one network. So we say it's 23 markets because it's in 23 geographies in a country. So this is actually India, for your information. And in India, the market is the business, the whole country is divided into multiple states, and some states are grouped together, some are independent states for the purpose of this telco's business, and that's how they have come up with 23 markets across the country. So that's 400 million subscribers who are using, whose data is being handled by our product, and we are 24/7. We are churning out a lot of information for our customer to use that in their marketing activities. I now move to the next slide. So it is important to know what the business is. I'm sure quite a few of you know that you already have, you already know what the business is. But all the same, I would like to touch upon it a little bit. So we are clearly trying to solve a particular problem in the telco industry. What is that problem? The revenue is dropping. As we all know, the average revenue per user in the telco industry is dropping constantly because of competition, consolidation, and a variety of things like that. At the same time, retention is reducing. They are not able to hold on to the customers. There's churn. People, because of mobile number portability, people move from one network to another network. That happens. And the whole digital engagement. In these days, particularly during the pandemic days, and I'm sure post-pandemic as well, digital engagement is a very, very critical element. And that is suffering. They are not able to engage deeply. In a business where, somebody like me, I use my phone, a lot every day, and that's the same with everybody. So in an industry where the touch point is quite extensive and I'm using the phone all the time, it is very important for my provider to constantly engage with me, to understand what my needs are, the changing needs for that matter, and serve me. And when that doesn't happen, it's poor digital engagement and poor brand visibility. So when that happens, the brand suffers over a period of time. PELATRO has a few solutions, like campaign management solution, data monetization, and loyalty management solution. These solutions help to solve these problems, and the result is higher revenue, better visibility of the brand, lower churn, and things like that. So that's what we do. So we're solving a very critical problem. So we are considered to be a very, very important partner of the telco, and we serve telcos at this point in time. But at some point in time, we could start serving other B2C companies and brands as well. Now, we do have a plan for that. I'll talk about that a little later. So looking at the customers that we have today, it's quite widespread. We've got about 20 telcos. When we actually became a public company towards the end of, in December 2017, we had only 6 customers. But now we've got 20 customers. So from December 17 to December 20, so that's just in 3 years, we've gone all the way from 6 customers to 20 customers. So that's quite a growth, and that has resulted in 35% revenue CAGR for the business. With the this is despite the drop last year. With the kind of growth that with the kind of revenue that we are hoping to have in 2021, this will grow even further. This will go up even further. So that's the customer base. You will recognize some of the very big names like the Telenor Group, Singtel Group, Axiata Group, Ooredoo Group, Vodafone Group. These are all large telco groups, Tele2 Group, and we are with them in all these locations, in all these countries. Moving to the next one. So we've been talking about the recurring revenue, which is a very important element. As you can see here, the annual recurring revenue has been growing. When we started this whole process in 1920, we had very little of annual recurring revenue. It was initially 0, then moved to 1.5, then $4 million, and now $5.4 million of annual recurring revenue at the end of December, at the end of 2020. That's in December 20. The recurring revenue as a percentage of total revenue, that's been growing nicely as well. It's gone all the way up to 71% in 2020. And in 2021, we expect that to be between 80 and 85%. And we expect to kind of stabilize at that stage, at that level. So going forward, in any given year, our recurring revenue will be at least 80% of the total revenue that we have. And so this company has now become a recurring revenue company rather than a licensed company. So the recurring revenue is nothing but a SaaS revenue model. I'm now moving to the next slide. So now this is an extremely important slide. So the company has been growing and will continue to grow in our historical business, in our traditional business. But there is a natural evolution, that's happening at this point in time. Today, we are with a very large number of telcos, which means a very large population of each country that we operate in is being monitored by us. Their data, their information, their calls, everything is flowing through our product, which means we are collecting data about a very large number of people in each country. That means we can, sorry, my apologies. That means we can get into data monetization, the monetization of that data on behalf of the telcos. So we'll partner with the telcos, they'll permit us to monetize it, and we will take consents. We'll do it in an anonymous manner, ensuring GDPR that we are compliant with GDPR at all points in time. And we will use that data set to help other B2C companies and brands to perform targeted advertising. So how does this work? There are these B2C companies and brands. So if you look at somebody like a Unilever, a Procter & Gamble, Lloyd's Bank, all of them are brands or B2C companies, business to consumer companies. And they have a lot of budget for advertisements, and they advertise through their ad agencies. It's the ad agencies who go and actually get the ads placed in different media, different channels, and collect the money for that from them and pay onto the people who actually help them advertise. Now that is going to be PELATRO. So the ad agencies will work with PELATRO. So that's our product Mviva, and using Mviva, PELATRO will send appropriate campaigns and promotions to the subscribers of the telcos that we have as customers. So essentially, PELATRO will tie up with the ad agencies, and we will sell what we have on offer, which are essentially segments of subscribers or data sets. That is what we are there to sell. And the ad agencies will bring us business from these brands. So they'll come and tell us that they want, on behalf of Unilever, they want a particular ad to be sent to 20,000 people who meet these criteria. Then what we will do, we will go and find those 20,000 people, and we will send the campaign. So naturally, these people will not be exposed to the brand. The numbers will not be shared, nothing of the sort. So anonymity is maintained, and it'll go only to those who have given consent. We will send that. Then we will get paid by the ad agency on the basis of what they get paid by these players, and we will share a portion of that with about half of that actually with the subscribers. Oh, sorry, with the telcos. So with our telco customers. This is a huge business. So this is the mobile ad business. It's about $100 billion in revenue at this point in time. The CAGR is 27%. Of course, the likes of Google and Facebook are the granddaddies of this industry. They're very large. They will continue to be large, but we have a place to play as well because of our relationship with the telco. So how have we been preparing for this business? If you look at there are three parts to this. One is the model itself. So over the past 2 years, we have repeatedly stated that we are changing our revenue model from one-time revenue to recurring revenue. So that's been happening. So that's already in place. So the model is recurring revenue, and mobile ads is also a recurring revenue business. We have built a solution to handle the mobile ads. So that is what we have done is apart from having all the data from the telcos, we have put models on top of that. We have put algorithms on top of that in order to be able to come up with inferred data, derived data, which is even smarter data than the underlying data, than the metadata. So PELATRO has been working on that over the past 2 years, and we are ready with that. And now we also have a very strong base. We've got lots of telco customers who have lots of individuals as their customers, consumers as their customers, and we have access to that. And I'll show you what I mean by that very shortly. Sorry, apologies. So in short, over the past 2 years, we have essentially been preparing ourselves to address this market, which we believe is a very significant opportunity for us to go after. And in due course of time, we believe it could be as big as our historical business, or it could even be bigger. So let's understand what we will be targeting. So initially, we intend to target these 6 countries. Now, in each of these countries, we've got multiple telco customers. In Myanmar, in Thailand, in Malaysia, and in Bangladesh. We've got 2 telco customers each, 2 telcos. And they have that sort of penetration. So we are getting the data of 40 million of 54 million people in Myanmar, 55 million of 69 million people in Thailand, and so on. So as you can see, in each of these markets, we have got huge penetration. So here it's almost like 70% penetration, or more than 70. Here we've got more than 80%, almost 80% penetration of the population of that country. Now in Bangladesh, it is 90% penetration of the population of the country. India is about 25% penetration, but that's 25% of a very relevant middle class. So it's almost like 60% of the middle class when we say 25% of the whole country. So on the whole, we are collecting data of about 673 million people who live in these 6 countries. Now, out of that 673 million, even if 200 or 250 million people are very relevant people with regard to their purchasing power and things like that, the brands and B2C companies would be very happy if they can send targeted campaigns through us to those people. And that's our value proposition in this mobile ads business, which we believe will give us some significant growth. And this is exactly what Gartner has been saying as well. Gartner has said that telcos, the telecom companies, should develop a trusted data provider position with brands, agencies, and the rest of the ecosystem. Now, the telcos themselves are not doing it, so we are doing it on behalf of the telcos. So we, along with the telcos as partners, are in the process of building or developing a trusted data provider position. So when the brands, when the B2C companies need to access people, they can come to us for exactly that, to send targeted advertisements to very specific communities or segments or groups of people. With that, let me move to some potential numbers that are possible from this particular business that we are talking about. We believe that, going by I don't want to go into specifics at this point in time, but over the next 2 to 3 years, in the interest of time, because we also need to ask some questions later. So in the next 2 to 3 years, by 2020-24, we believe that this business will get us almost $15 million of revenue every year. At that point in time, our traditional business, historical business, would also be probably about the same size. So this will almost equal. So in a sense, we are getting into a new space which is as big or bigger than what we are in at this point in time. With that, I get to the financial section. I will now hand you over to my colleague, Nick. After he's with his section, we will get to the questions. Nick, over to you. Thank you.
Thanks, Subhash. So if we just look at the highlights for the year, and as Subhash has already flagged, clearly the year just gone was a down year in terms of revenue for us for the reasons we discussed. Now, I'm conscious that some of you may be new to the company, so I'll give a little bit more detail than usual. But just a recap on the license versus recurring revenue model. When we sell a license, and let's just say we sell a license for $1 million, that's a one-off revenue by and large. Yes, it comes with some ongoing support revenue. Yes, it comes with some change request revenue as well. But think of it as a one-off lump of $1 million, which comes in the revenue for that year. The equivalent managed services contract might be, and I'm slightly making up the numbers, 5 years for, say, 300, 400,000 a year, something like that. So obviously a bigger number in dollar terms over the life of the contract, but in individual 1 year, you'd have 1 million versus 300,000 or 400,000, something like that. So you can see that the move from license income to recurring revenue income means that there's a change in the number reported. Over the life of the contract, managed services contracts are almost always better for us in economics term, which is why we have been chasing them. So that's what's behind that revenue number for 2020, which clearly was down from 2019 and even indeed 2018 before that. We've already put out some statements about the year we're in now, 2021, which shows that we're pretty comfortable with that number being significantly higher. So 2020 was very much a year of summary, of transition for us. The EBITDA obviously followed that, no surprises there. We tend to manage the business on a cash basis. So the cash costs that we incur, roughly $6.3 million last year, are spread amongst the P&L. And we'll come on to that in a minute when we go on to the P&L, between the cost of sales, the OPEX, and also we capitalize our development costs. Again, I'll come back to that when we talk about the balance sheet and the cash flow. So cash costs were up by about $400,000, just under. The vast majority of that is people costs. Now, that was offset by, for obviously reasons, a reduction in travel costs. Clearly, in a quotes normal year, we would expect to be incurring quite significant travel costs, both in terms of marketing and also a lesser number, but still important, implementation, which is when we have our guys going out to install the software on customer premises. Now, one of the benefits and silver linings of the pandemic was that we learnt how to do implementation almost entirely remotely, which obviously going forward will cut that travel and other cost number significantly. Clearly, there'll still be marketing costs, but as I say, that led to a reduction in travel costs of around $400,000, something like that, last year. And the reduction in the implementation cost will be something which is a permanent feature of that cost base. So that's the summary. If I move into the detail of the P&L, and again, I'll just touch on a few. I'll go into a little bit more detail than usual, given that some of you might be new to the business. We talked about the revenue number. Cost of sales. Some people get too involved in the cost of sales number as a standalone number. It's not by itself a particularly meaningful number, and that's for the following reasons. Firstly, we are still selling licenses, and we are still selling change requests and support and things like that. If you sell a license, going back to my $1 million made-up license, that in cost of sale terms costs you practically nothing. It might cost you $25,000, $40,000, something like that for implementation, but it's almost zero. So the cost of sales for a license is zero. For the equivalent managed services contract, you would be incurring people costs, because we have to have people going to the usually on premise, sometimes not. But in the case of the big contract in India, that's 40 odd people on premise in the customer's location. So you can see that's a very different cost of sales. So in that 1.71 number, you can imagine there's a whole load of costs which go in there, which by itself, you can come up with a margin number, but isn't particularly meaningful. In 5 years' time, if, and it's a big if we were just doing managed services contracts, that might be a meaningful number standalone. But really, you've got to take it together with the other P&L costs and to some extent the capitalized costs to get a proper picture of our underlying cost base. So that's cost of sales. Overheads look like they've gone down. Again, that's a slight bit of accounting allocation, where I've said that, yes, we did have some reduction in costs, mainly travel. A large part of that is more that when we, obviously in any 1 year, we gain employees, we lose employees. Typically, in fact, almost exclusively, the employees we lost last year would have been people who would have gone into overheads, and the vast majority of people we gained last year would have gone into to cost of sales. So all other things being equal, cost of sales goes up, overheads go down. There are some differences alongside that, which I won't go into the detail. But that's, again, you shouldn't read too much into the apparent reduction in the overhead expenses. So that gives us the adjusted EBITDA number, which is still positive. Amortization, it's a big number. The bulk of that, 1.4 million, is amortization on our underlying software. We capitalized 2.8 million last year and amortized 1.4. So that gives a net benefit to the P&L of 1.4 million. But just to show you that that's there. Exceptionals, nothing strange about that. What that was people who've been following us for a while will remember that we bought a business called Danatech back in 2018. That acquisition had 2 earnouts attached to it, payable potentially in 2019 and 2020. The 2019 payment was 0 because it didn't qualify for it. The 2020 payment was, in gross terms, $1 million. In actual fact, with various adjustments under the sale and purchase agreement, it came out at 850. The exceptional item is just the difference between that eventual payout and what was in the balance sheet as the liability. So effectively a non-cash item. Amortization of acquisition-related intangibles, that's the customer base we bought and had the value under the accounting rules as part of the Danatech acquisition. And the rest of the P&L, the bigger numbers there are the finance expense. As we'll see when we get onto the balance sheet, we borrowed money last year to fund the acquisition of hardware needed to service the big Indian managed services contract. That was about $830,000. Now, the reason that's on our balance sheet is because there's no such thing as a leasing product in the Indian market. So effectively what we had to do is buy it ourselves, goes on our balance sheet, and we took a 6-year term loan to fund that. So effectively match funding that. Now, in practice, actually, the loans in India are structured on an equal monthly installment basis, a bit like a mortgage, and those payments are very comfortably covered by the monthly income from the underlying contract. So that's something we're perfectly comfortable with. But that explains that increase in finance expense. Just lastly, I'll touch on tax. And most people's eyes glaze over when it gets to the tax line, but it does look a little bit unusual because it's a negative tax number, i.e. a charge, whereas there's a loss before taxation. That's for 2 main reasons. Firstly, because our underlying tax base is mainly in the Indian company, which needs to be taxable on a standalone basis for local tax reasons. So there's always a tax charge there. And secondly, our revenue, given the geographic spread of our revenue, we do suffer withholding tax in various locations, not everywhere, but in several locations. And that withholding tax can sometimes be offset against other tax liabilities, sometimes not. So a result of that is that there's a tax charge for that. So that's the P&L. Just moving on to the balance sheet. Again, I'll do a little bit of detail for those of you who are less familiar. The intangible assets is probably the biggest number on there. That is, most of that is, well, not most, around half is the value of the net book value of the software we've developed. The balance is, broadly speaking, the acquisition assets, the Danatech assets, mainly the customer relationships. With 30 seconds of history, one of the key things that acquisition brought to us was a framework agreement with a big international telco group, which in very summary terms gives us preferential access to the companies in that group, which is obviously hugely valuable. And we have and continue to exploit that agreement in terms of getting new licenses. So that's valued on the balance sheet. Property, plant and equipment, 1.2 million. That's the other side of the hardware we acquired to service the managed services contract in India. The rest of the numbers on the non-current assets are fairly small and obvious. Trade receivables, people have often quizzed us about the trade receivables, both the level in terms of the actual amount versus the revenue number, as well as the collection time, which is probably the flip side of the same coin. We haven't had a bad debt to date, and we don't intend on having one. Those receivables have gone down, obviously, this year, mostly in line with revenue. As always, the devil is in the detail. There's a lot of different things underlying that, and just doing a simple debtor-day calculation really doesn't tell a story. It gives a number, but it's not a particularly meaningful number, and certainly we don't manage it by way of looking at that number because it's too the individual constituents of that number are too varied. We manage it on a customer by customer basis. I mean, we've got in round numbers 20 customers. It's fairly easy to monitor what they all owe us. So that's the trade receivables. And as Sebastian, I think, mentioned at the beginning, we've collected just over half of that already this year. So we're perfectly comfortable with that. The cash, we closed with cash of 1.8 million. As you'll see, and as you might recall, we did raise $2.6 million net last year to fund various things, and some of that cash is obviously still on the balance sheet. If we look at the liabilities, the borrowings is a big number, but as I say, that most of that was done to acquire those hardware assets. So that's just the other side of that. Otherwise, I don't think it's anything unusual there. Other financial liabilities right at the end, it's a zero. And was 950,000 last year. That's that Danatech liability, which was sitting there because we obviously the payment was coming up in 2020. So obviously that's now gone. There's nothing further payable on that. So the balance sheet is totally clean from that perspective. If we look at the cash flow, stronger than last year, and that's been a feature of the last 2 years. Our cash flow has been strengthening in terms of the operating cash flow, which is obviously good news. You can see where that's gone. Yet again, there's the 900 sitting there, which is most of that is the hardware. There's 1 or 2 other things in there as well, but nothing particularly exciting. The 2.8 million, that development of intangible assets, that is what we capitalize in terms of our development costs. Now, again, some people query that. They say, well, how come you're capitalizing such a large amount? That's simply that that's almost entirely, in fact, that number is entirely staff costs. Those are our development team, and then we've got, I think, in round numbers, it's probably sort of 80 plus developers, probably 90, something like that. So you can imagine that's quite a big number in terms of staff costs. That is, we are required to capitalize that under the accounting rules. There's no discretion there, so it's not something we necessarily choose to do. We manage the business on a cash basis, so that number by itself is not particularly relevant to us. We look at the total cash cost of everything, and people is the vast bulk of that. Probably 80% of our costs in total are people. It's just that's where it goes on the balance sheet and in the cash flow. So that's that number. You can see the 850 going out there. That's the Danatech earnout, the final earnout, as we discussed. And in the financing block, you've got the $2.6 million coming in from the issue of shares we did last year. And if you net the various borrowings there, that nets out to be the roughly $900,000 we borrowed to fund that and the finance costs as well. So all of that taken together meant that we ended the year with a 1.8 million of cash on the balance sheet. In summary, just before I hand back to Sebash, clearly, whilst 2020, looking at it standalone, was a down year, we ended it in a much stronger position with a very substantial order book and visibility, largely driven by the fact that we've been taking on board these recurring revenue contracts, managed services, and others. In particular, the big contract we've talked about, which is across a network of 400 million subscribers. It's not a significant number, but it's helpful, and it's very high gross margin. But existing customers are increasingly coming back to us for high value add services, consulting or other operational services, training, things like that, which again adds to our recurring revenue. I won't recap the information that Sebash gave you on the ad space. We talked about that, but clearly that's hugely complementary to our existing operations. We're expecting revenue 2022 or possibly even 21. Coronavirus, we have to mention that. I think we did have some uncertainty last year, of course. No one could completely escape it. But in our view, the telcos, our customers, have now settled down and are starting to contract with us again as usual. So that's, I think, the hump is over for us. And therefore, the summary of the above is that we are very confident in meeting our expectations for the year. At that point, I'll hand back to Sebash and/or to questions.
Thank you very much indeed. Sebash, thank you, Nick, as well, for the presentation today. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. Sebastian, Nick, as you said at the outset, we had a number of pre-submitted questions from investors, and perhaps I can start off the Q&A session with these. The first one reads, what historically has been your pipeline to order conversion rate?
Typically, that's, are you able to hear me, Paul?
Yes, we are, sir. Yes, we are.
Thank you. So typically, that's been about 30 to 40% conversion. The next question, please, Paul.
That's fantastic. Thank you indeed. The next question reads, the revenue growth at PELATRO has not been as strong in the last 12 to 18 months, even though telecom companies have done well. Is this just COVID or is there anything else?
So as I explained initially, this is only because we changed our revenue model. So when it's a license revenue model, so we get a chunky revenue straight away. So if we sign a license, immediately we get $1 million or $1.5 million into our books straight away as revenue. But when it becomes recurring revenue, during the course of the life of the contract, so maybe 3 years or 5 years, it could be $1.5 million, $2 million, $3 million, whatever, but then it'll come in as monthly amounts. So if it's a 5-year contract and $3 million, so 3 million divided by 60 is what we'll get every month. So naturally, the revenue will come down quite dramatically. So this is the sole reason why the revenue went down last year. Thank you.
Thank you so much. Next one we've got here, PELATRO brings together BI systems and campaign management systems and does so seamlessly with limited to no programming required to manage campaigns. Is this still PELATRO's USP or have competitors brought out similar solutions, and has the competitive landscape changed recently?
When we actually came onto the scene a few years ago, our product was way ahead of our competition in all these respects and more. We are continuing to maintain that. As a small organization competing with the likes of IBM and SAS and Oracle, etc., we have to absolutely have the best product out there. Otherwise, there's no reason why any customer would come to us. So we are maintaining that gap between us and our competition, and we'll continue to maintain the gap going forward. Thank you.
Thanks, Subhash. Okay, has there been any substantial order booked for the new mobile ad business?
Not yet. We are just entering that space at this point in time, but we're entering a space where we'll be partnering with our telco customers to sell this to the ad agencies, and we believe we will get hopefully some revenue this year, and definitely quite a decent amount of revenue next year. But that's not in our projections either, and we haven't got anything as yet. But we are on to that. Thank you.
The next question is sort of, well, about 4 in 1, but let me go through them. Can you throw some light on the mobile ad business? The second part is it going to be location-based advertising? Will it allow better profiling and targeting of the ads? And where will these ads be shown to customers? Through text message, ads on web pages?
Okay, now I'm also seeing a couple of questions of a similar nature in the chat, in the Q&A box here. So I'll try to answer all of that together. So this way it works like this. We are the ones who will be delivering the ads to the subscribers or to the customers of the telco. So the ad agencies will come to us for a request for a specific ad for a specific set of customers. Then it is our job to handle, because we handle our platform, we have our software solution. So it's PELATRO's job to do the segmenting on the platform to meet the expectations of our customer. That is the ad agency. So we'll do the segmenting and we will send the ad as we have been asked to send through the channel that we have been asked to send. So it could be a text message. It could be a video playing on the app, for example, or it could be a video playing in an email for that matter. So it could be any channel. So it's not just text messages. It's different channels which are, the media-rich channels also will be used. So we have access to all those channels and we'll be using those. And yes, it will be, some of them will be location-based. So when a particular individual is near a particular location, the particular ad will go to that individual. And we will be doing a lot of, see, the segmentation sits on top of profiling. So we would have already profiled all these people and kept that ready, and the profiles ready, and using those profiles, that's the personas. We will do the segmentation and then send the messages. So that I hope I've had. Okay, I will also add one more point. Which is there in one of the questions. Are these basically ad exchanges or things like that? So no, we're not bidding anywhere, because bidding happens when there is somebody else who's delivering the ads. In our case, it's we who deliver the ads. So the advertiser, the B2C company or the brand will approach us through the ad agency, requesting us to send an ad, and the channels are available to us 24/7 to send the ads. So there's no bidding, there's no programmatic advertising, nothing of the sort.
Thank you very much for that comprehensive answer. Next one we have here, the penultimate pre-submitted question. Are you targeting the mobile ad business to contribute to the top line this year? And are you expecting added costs this year due to the mobile ad business, irrespective of any sales wins?
We are not expecting too much of revenue from it this year because we're just getting started. At the same time, I wouldn't say nothing. There's definitely some revenue expected this year, but that's not in the current guidance as it stands at this point in time. There'll be some cost as well that we'll add, but I don't think that's going to be a humongous cost this year.
Thank you, Subhash. Final question we have here for pre-submitted is, what is not so encouraging are the net profit forecast by the company's house broker for the next 2 years, where they assume a strong sales growth rate but a break-even net profit. Appreciate EBITDA is positive. Do you think this is a very conservative forecast, or is the profit growth expected to be so far behind the sales growth at this stage of the business's development?
We are actually getting to a stage where the nonlinearity of the business will start to kick in. So at this point in time, the sales growth is definitely, the profit growth is definitely lagging. That will catch up, and that's also a function of the license revenue shifting. So during license days, we had much better profits. Now that it is, a lot of it is recurring in nature, naturally the profit growth has to catch up. So the revenue part of it has caught up now. The profit part of it will catch up in the next couple of years. So until then, whatever numbers that you're seeing are, will be what will be happening as well.
And also, if you're looking at the profit before tax, we do suffer from a large amount of amortization, much of which is technical because it comes from the acquisition where we're amortizing the previous valuation of customer assets. Now, to just go into 30 seconds of accounting detail, when you buy a business, you can't just put everything down to goodwill these days. You have to do what's called fair value accounting. You have to attribute a fair value to the value of the customers and other intangible assets you've acquired. So you put that on the balance sheet. You then have to amortize that. So it goes against the P&L for every year you're amortizing it. Some of the assets we acquired were amortizing it over 5 years, some over 10 years. But it's still a drag on the reported profit. So I would look at EBITDA as a far better proxy for the actual underlying profitability of the business.
Fantastic. Thank you very much indeed. Sebastian, we have had a number of questions during the live event, some of which we have covered off, I know, in the presentation and in the Q&A session that we've already had. But perhaps I could just draw you just to click on that Q&A tab, and if there are any further questions that you could shed some colour on, that'd be really helpful.
Okay, so I will take a go at it first. I'll go through the questions and answer those that I can. I will also read out the questions. Is that fine, Paul?
That is absolutely fantastic. Thank you, Sebastian.
Thank you. So the first question is, how do you see the growth at Pelatro, client wins and revenue as compared to the firm that you founded earlier and took to IPO? In earlier days, in pre-COVID days, I would say we used to win 4 or 5 customers a year. The change to that is, given that we are not able to travel, we are not able to meet anybody, the sales cycle has certainly lengthened. So given that these days we expect to win 2 or 3 new customers every year. But the interesting thing is that we have a very large number of existing customers whom we can continue to mine very deeply. And that is what is also happening at this point in time. So our growth, whatever we are talking about, the consensus number now is $7.2 million of revenue for this year as against $4 million last year. That will happen. And for next year, Cencos has put out an $8 million revenue number. We are quite confident that will happen as well. So this sort of growth, for that, we do have adequate business happening at this point in time. The next question is about ads. I've mobile ad business, which I have already answered. The next question is, presumably the link with advertising agencies is automated, so you must require infrastructure. Are you saying this is all in place and can cover? Okay. Now, there are two ways to do this. It can be manual, it can be automated, depending upon what the ad agency wants to do. If they want to automate, this is exactly what we have been developing over the past 2 years. We have already developed the automated linkage between us and the ad agencies for segmentation and delivery of ads and stuff. So the entire process, including settlement of bills at the end of the month. So that solution is what we've been developing over the past 2 years. That's already developed and in place. So we don't need additional infrastructure or investment into software development for this particular activity. The next question is, what's competitive landscape like and how do you sell into such large clients? Well, the competitive landscape is pretty much the same. IBM, SAS, Oracle, and Oracle, Pega, and a bunch of smaller players. The way in which we sell, but we have been very successful in replacing these incumbents at various large telcos. And that's because of solely, I would say, on the strength of the product and the kind of support and services that we have to on offer. So I can only say that our product is very, very strong, and I really believe that it is the best product out there. So it speaks for itself. So that's the strength of the product. Why did recurring revenue reduce from 2.96 to 2.85 when with the switch to such revenues? I would expect them to have risen. There were some timing issues last year with regard to some of the contracts. I mean, so that that lengthened. So that was the primary reason why. And it's a very small number that we have, $140,000 kind of number that we are talking about now, $110,000 actually. So that there was a bit of a timing issue with regard to conclusion of certain activities and getting approval from customers, because every month when we conclude an activity, we recognize the revenue. We have to get approval from our customer as well that yes, it is delivered. That's what the auditors look for. So that was only a timing issue there, no other reason. The next question, why was there no growth in the actual amount of, okay, that's already answered. That's the same revenue question, so that's all answered.
Yes, Subhash, there's another point there, which is the big contract we took on. We only recognized around $600,000 of revenue from that last year because of the timing point you mentioned. On a run rate basis,
it's all down to timing. It's all down to timing. The next question is, are you being affected by the political problems in Myanmar and the worsening pandemics in India? No, we are not. As we speak, we are implementing a solution remotely. So it's all done remotely. So none of us are in Myanmar. We are doing it all remotely. So neither of these issues are impacting us. I will leave the next question to you, Nick. I'll read it out. Why is capitalized development approximately 60% of staff costs in the past 2 years? Why does it rise with revenue?
Sure. Well, the 60% is almost exactly the proportion of developers to our total staff costs. So that's why that number is there. As I said, we have people who are specifically devoted to developing the software. They are capitalized under the accounting rules. So the 60% number is exactly that number. I don't think it does rise with revenue. I mean, clearly our revenue fell last year, and the proportion, the capitalized cost rose to 2.8 from either 2.1 or 2.3 from memory. I can't remember. And if you look at the Senkos note, I think they got in either 2.9 or 3 for 2021, and clearly the revenue they have forecast is 7.2 against 4. So there is no, I don't think it does correlate with revenue, and equally there is no reason for it to correlate with revenue.
Okay, going to the next question. How far along are you with discussions with advertising agencies, and when do you expect first revenue? We have started making progress. We have not quite signed up anybody at this point in time. That's why we are saying we're expecting some revenue this year, and probably not a humongous amount. We expect the first revenue in the next 3 to 4 months. What prevents a customer leaving you upon expiry of the ARR contracts? Well, the only insurance policy that we can have against such an eventuality is the quality of the product and the quality of the support and service. As long as that is there, then there's absolutely no reason. As long as they're happy with that, there's absolutely no reason for anybody to leave us, because leaving us is a very painful process. It'll take them a very, very long time to remove our product, migrate to a new one, implement that, etc. So it'll take them like 7 to 8 months. So nobody, no telco will ever move from one product to another product as long as they're happy with the product. So we have, in my earlier company, Subex, which I ran for 20 years, we never lost a single customer. In Pelatro, in the past 5 years, we have not lost a single customer, and we will not lose, because it is in our hands, and we will ensure that they're happy at all points in time. And that means that, you know, the product has to continue to evolve. It has to continue to be the best out there. So then they'll have no reason to move. Next question. You have announced recently additional revenue from change requests. Is the revenue from change requests, the revenue from change requests, whether it's recurring or one time is a question. It is actually one time. It is not recurring. But the interesting thing about change request is that every customer keeps giving us change requests one after the other. It's a constant process, because this is a very dynamic industry, and marketing is an art. It's not a science, as you know. So they keep having new and new requirements. So they will keep asking us to tweak the product, to modify the product, to add things to the product. So that's a continuous process. So while theoretically it is one time, it is actually recurring because of the very nature of it, as in, like, you know, it keeps coming. So that's what it is. So historically, the same customer keeps giving us again and again. When you conduct data analysis, who owns the data analysis, you or the telco? The data is always owned by the telco. Whatever we analyze and whatever insights or findings we come up with, all that is owned by the telco. But the telco has permitted us to use that in the mobile ad business. That's how it is. The last question I have here, what is the average value of a contract and how fast is it increasing? The average value, it depends, you know, if it's a license contract or a recurring revenue contract. But our typical customer, you know, typical size customer is probably in the region of about $400,000 a year. That's it. If there's any.
Subhash, thank you very much. You've been hugely generous, and Nick, thank you as well for answering every single question you've had through. So really do appreciate that. And if there are any further questions that do get submitted, of course, Subhash and Nick will be able to review those on the Investor Company platform. Subhash, may I just ask you just for a few final words, just to wrap up before we redirect investors to give you some feedback?
Well, so this company is definitely at a position where the growth will be quite attractive, and it will be profitable growth in the years to come. And that is because of two reasons. In our historical business, in what we have been doing, till now, we have reached a position where we are quite strong, and will continue that position and keep building on the foundation that we have built. And in the new business that we are looking at, which is the mobile ad business, we think we have got a very unique position there with loads of data and ability to infer more data from that, insights and things like that, which will further enrich the data that we have. And that will give us a very unique position in the mobile ads business. So between the two, I think we are onto a very interesting period of time. And these things do not happen by chance. I mean, over the past few years, the company has been very systematically, painstakingly, carefully building the foundation brick by brick. And some part of that is over, and the rest of it is continuing. But suffice to say that now we have left most of the painful part behind us, and we are looking forward to a very fruitful in a future going forward.
Fantastic. Subhash, Nick, thank you again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected for the opportunity to provide your feedback. If you've accessed the meeting from our website, the feedback page will appear in front of you. But if you've accessed the meeting via the link sent to you by email, you'll simply be asked just to log back in and submit your feedback. It only takes a few seconds and be greatly appreciated by the team. On behalf of the management team of PELATRO PLC, we'd like to thank you for attending today's session. That now concludes the event. Thank you.
And I take this opportunity to thank everybody.